G'day investors. Welcome to Pete's Investing. No bull dust trading opportunities, just simple, reliable trading ideas. But first, there's a disclaimer. We do not offer financial advice. We do not issue advice, recommendations or opinions in relation to acquiring, holding or disposing of your products. Past performance is no guarantee of future results. And this is purely an educational video series to equip you to better understand how to trade or invest in these products. Okay, let's get going. Today's session, we're going to be talking about some simple trading strategies, or at least one strategy that I've used that's been quite effective. So the strategy is to buy low and sell high. Obviously, we want to go long in this position. Going long means buying low and selling high. If you want to go short the market, you enter the trade high and you aim to sell it or to close it out at a lower position. But we're going to focus on going long only, buying low, selling high. In this strategy, we're going to enter on the moving average of the CCI 100, the moving average 20. When that crosses above the zero line, that's when we enter the trade. That gives some indication that the price is moving in a more positive range. And I'll talk about the exit shortly. And selling high. In this example, you can see we did that. So what we're doing is we're focusing on the commodity channel index. The commodity channel line is this jagged black line. And what we do is to smooth it out a bit, put a moving average 20, which is the dotted blue line. So we track that, which goes against the commodity channel index. So once the moving average 20 moves above this red line, we enter the trade. As you can see here, I've written another little indicator which creates these spikes every time the moving average, the dotted blue line, moves above the zero. So you could have entered the trade at any one of these spikes. In this example, we'll focus on entering here and exiting the trade here, and I'll explain how that target is hit. Now let's focus on this indicator also, which calculates the previous 30-day range of movement. So you can imagine between the highs and the lows, it's saying, if you look at on that fine blue line where the cursor is, it says 53.36754. That's saying it's moved between the highs and the lows of price movement in the previous 30 bars. It's moved 53 points at that particular point of that bar. Now what this dotted line does, it simply adds the bottom number, the overall average, to the close of the price in the chart. So it adds this value to the price up here, and that gives you a number in this example, 6542. So if you look at the values there, the overall average, the blue line at the bottom, it says overall average 53.81191 is added to the close of the bar chart above. The close is 6488. So 6488 plus 53 gives you 6542, which is the dotted black line. So that's basically saying there's a target there. Once you enter the trade there, there's a target price, 6565, which happens to be about there. Now the reason it hasn't closed out there is because the second parameter of our exit strategy says, that's the first parameter, it must meet that range at least before you can exit the trade. The second parameter says, as soon as this moving average, this brown line, that's a moving average 200, as soon as that brown line starts turning down, that's when you can exit the trade. So theoretically, that's assuming the price it wanted to hit was about there, and the moving average, so that was there, that's assuming the moving average, the 200 moving average turned down there. It theoretically could have closed out there. But in this example, the moving average kept going up because the price kept going up. We're well above our initial target price. So based on that second parameter, it closed out there. And that gives us a nice little range of profit. Now we entered 2 contracts. So if you look at the number on those bars, it says positions 2. So for each one position, let me draw the ruler so you can have a better look at it. So let's assume we entered the trade there, plus or minus a few points, and we closed out there. That's about 118 points between there and there. So 118, if you calculate the difference between 2543, 102,543 minus 102,303 is about 240 odd points. And 240 is double that. Don't forget we've got two contracts we've entered, so it's 2 times 118 roughly. And that's our little strategy to entering one contract or one set of contracts when the price goes in our favor. In a future video, I'll explain what we do when price goes against us. In this example, we entered the trade there because the CCI broke above the zero line. It's given us a target. We haven't hit that target. The price turned down. But down here, we enter another trade. And I'll explain why we enter that trade in a separate video and how that becomes profitable. Thank you for watching. To get notified of all future videos, be sure to subscribe and click on the notification bell below. See you next time, guys. Happy investing.